Before every single major market crash in the last 50 years, a few specific signals have flashed bright red. These aren't secrets buried in some complex formula, they are open signals tracked daily by the world's most successful investors. The smart money, so they can see the storm coming and get their capital to safety before it's too late. And right now, while many are mesmerized by all-time high markets and the hype around the next big thing, these old school signals are telling a very different story. A story that points to a major shakeup circling the year 2026. And I'm going to show you exactly what these final warning signs are and how to read them like a pro, and most importantly what they are telling us right now. And this isn't about fear, it's about preparation. We'll look at the data, connect the dots, and by the end you'll understand the playbook the pros use to protect and even grow their wealth when everyone else is running for the exits. So the first and arguably the most reliable warning sign is something you've probably heard of, but maybe never had explained in a way that just clicks. It's called the yield curve, and its inversion has popped up before pretty much every user session since 1917. While it's not a perfect one-for-one guarantee, no other indicator has a track record quite like this. So what is it? Think of the yield curve as a measure of the trust in the future. In a healthy economy, if you lend money to the government, you'd expect to get a higher interest rate for a longer loan. A 10-year loan is riskier than a 2-year loan, so you demand more money for it. A graph of these interest rates or yields normally slopes up. Simple. Every so often something weird happens. The curve inverts. This is when short-term rates like for a 2-year treasury bond becomes higher than long-term rates on a 10-year bond. Why on earth would this happen? It's because the bond market, trillions of dollars of the world's smartest capitals, starts to see a recession coming. Big investors get nervous about the near term and believe the Federal Reserve will be forced to cut interest rates in the future. So what do? Well, they all rush to lock in today's high long-term rates before they vanish. This massive buying spree pushes the price of a 10-year bond up, which pushes their yields down. The result, an inversion. The bond market is essentially screaming that a slowdown is on its way. This isn't just a chart quirk, it creates real-world problems. Banks, for example, make money by borrowing at short-term rates and lending at long-term rates. When the curve inverts, their profit model breaks, they stop lending and credit freezes up. That's how the signal becomes their reality. And history gives us a chillingly clear lesson. The yield curve inverted in early 2000, right before the dot-com bust. It inverted in 2006, a year before the global financial crisis, and it inverted again in 2022, staying inverted for historically long time. As of today, that spread between 10-year and 2-year treasury is positive again at about 0.55%. But here's the thing, the recession doesn't usually hit when the curve is inverted. It often begins after the curve uninverts. The inversion is the warning, the return to normal is often the sign that the fuse has been lit, the clock is ticking. If the yield curve is the long-range forecast, credit spreads are the market's real-time heartbeat. They measure the level of fear inside the corporate debt market. When this signal flashes red, the system is under stress. So what's a credit spread? It's the extra interest a company pays to borrow money compared to the risk for US government. If a 10-year treasury yields 4%, a safe company might borrow at 5%, the credit spread is 1 percentage point. A riskier company might have to pay 7% for a spread of 3 percentage points. It's the market's price for risk. In good times, spreads are tight or narrow. When fear creeps in, investors demand more compensation for the risk of a company going bankrupt. They sell corporate bonds and the gap between corporate and treasury yields widens or blows out. This is a powerful warning because it means it's getting more expensive for companies to borrow, invest, and grow. It starves the economy of credit and can tip a fragile situation into a full-blown recession. Leading up to the 2008 crash, credit spreads for BAA-rated corporate bonds, investment grade but on the lower end, hit a record of over 6%. That signaled extreme stress long before the stock market hit its final bottom. Today, the same spread is sitting around 1.69. This is not an alarming level, but it's the baseline from which a spike would occur. A sudden sustained move toward 2.5 or 3% would be a major red flag that the financial plumbing is starting to crack. Our third set of signs moves from the bond market's mechanics to the wild world of human psychology. These indicators measures euphoria and fear, that the drivers of every bubble and burst. And first up is the VIX. It measures expected volatility in the stock market. A low VIX, usually below 20, suggests a calm and complacency. A high VIX, especially a spike above 30 or 40, means fear is taking over. In the 2008 crisis, the VIX exploded to over 80, reflecting pure panic. Today, the VIX is hovering around a calm 16.65, but this is exactly the kind of environment that can breed the complacency that comes before a shock. The real warning isn't just a high number, but a rapid change, a sudden jump from 16 to 30 would be a moment the crowd started to smell smoke. Paired with the VIX are valuation measures. Are stock reasonably priced or are we in a speculative mania? Two of the most respected tools are the Shiller PE ratio and the Buffett indicator. The Shiller PE ratio compares the S&P 500 price to the average inflation adjusted earning over the past 10 years, giving a clearer view of the market value. The long-term average is about 17. Before the dot-com crash it hit 44. Before the 1929 crash it was at 30. Today the Shiller PE ratio is at an eye-watering 40.08. That's higher than almost any point in history besides the dot-com peak. Then you have the Buffett indicator, which Warren Buffett himself called the best single measure of where valuation stands at any given moment. It's simple. Compare the total value of the US stock market to the country's GDP. A ratio of 100% is seen as fair value. Today it's at roughly 178, suggesting the market is significantly overvalued. Some calculations put it even higher, around 221%. Valuation metrics aren't timing tools. They can stay stretched for years, but they are a measure of risk. It's like stretching a rubber band. The further you stretch it, the more violently it snaps back. We are currently stretching it to a degree seen only once before in modern history. So let's put it all together. This is where the pros separate themselves. They don't look at one signal, they look at a dashboard. So here's the sequence. So, first off, valuations get extreme. The Shiller PE and Buffett indicator climb to dangerous levels, making the market fragile. Then, the yield curve inverts. The bond market gives its most reliable warning of a coming recession. Check. We just had one of the longest inversions in decades. Leading economic indicators decline. The Conference Board's leading economic index, LEI, designed to peak before the economy does, starts to fall consistently. The latest report showed 2.8% decline over the last 6 months, signaling more headwinds ahead. Check. The slowdown is appearing in the data. The final stage is when the short-term indicators blow a fuse, credit spreads suddenly widen and the VIX spikes. That's the moment the meltdown truly begins. Those are the last dominoes to fall, and the smart money isn't waiting around to see it happen. So why 2026? This isn't a date pulled from a hat, it's a forecast based on historical lags between these signals and what happens next. The yield curve inversion started back in mid-2022. The typical lag to a recession is 6 to 24 months. However, some analysts believe the unique post-pandemic economy has stretched these timelines. Forecasts from major institutions now point to a significant slowdown in late 2025, with GDP growth slowing into 2026. The full impact of the Fed's aggressive rate hikes also takes 18 to 24 months to ripple through the economy. That timeline points to late 2024 and 2025 as the period where we'll see the real economic consequences. A hard landing in 2025 would likely cause the most severe market damage in 2026 as profits collapse and defaults rise. So 2025 looks like the year of a slowdown. 2026 then becomes the most probable window for the meltdown phase, when asset prices fully capitulate to the new reality. Over the next year, watch those last two indicators. Are credit spreads calm or are they creeping wider? Is the VIX dormant or is it spiking? Their behavior will tell you if the 2026 thesis is on track. So we've just walked through the dashboard the pros use. Valuations are at historic highs. The most reliable recession predictor has already sounded its alarm. Leading economic indicators are already turning down. The picture is of a system under stress, stretched thin and vulnerable. The final warning signs, spiking credit spreads and a surging VIX haven't flashed red in unison. Not yet, but the kindling has been laid. This isn't a message of doom, it's a message of empowerment. Fear comes from uncertainty. Clarity and preparation gives you control. By understanding these signals, you're no longer flying blind. You have the same dashboard the smart money uses. You can watch the data and make rational decisions to protect your wealth. Instead of being forced into panicked reactions when the storm finally hit, be prepared, not scared.